All right, what's up, everybody? Jack Retirement Guru here, aka Pierce Goodrow, president of C&G Insurance Agency, Life Insurance Financial Services, tax-free retirement, infinite banking concept, and annuity specialist. All right, so the last video, we're still on whole life, infinite banking concept right now. Last video went over. If you haven't seen that, go and watch that. Basically, it's showing how to structure, how to use this policy if you're buying car, really any of your needs, but it was structured towards buying a car and how you would do that. All right. This next one, we're gonna go over child's policy. So how you can set this up for your kids, no matter what age they are, um, as long as you are insurable or you have already some type of life insurance or one of these products, IUL, whatever. Okay. Basically, we're gonna show you how you can structure these and use them while your kid's still young for yourself, and then pass it on to them. All right. Pretty cut and dry. Let's go ahead and share the screen here real quick. All right. So I'm gonna take a sip of water here. Lafayette Life Insurance Company, based out of Cincinnati, Ohio. Been around for over 100 plus years. Okay. All right. So let's go over some key information here I've gone over in the past videos. All right. So it's child's policy again, female, age 5. Initial and annual premium is $3,000, equivalent to 250 bucks every month. Your initial face value is 107,195. All right, so let's go right here to dividends. These are how these products by Lafayette Life, I really like to call it a process, but how this product will help you accrue cash value over time. All right, so now as you can see in big bold, it says dividends are not guaranteed. Why is that? Because by law, the insurance company cannot guarantee you a dividend, but I can tell you by fact that if you go look it up, Lafayette Life has never once missed one dividend in the past 120 years. So I think it's pretty safe to say you're going to get a dividend, right? All right. So policy loans. Um, Basically, guys, I can go ahead and read this again, but I went through it in my last video. Policy loans. The whole point of this is what? Being your own bank, pulling out loans against yourself, paying yourself back. Is there interest? Yes, anywhere from 0 to 8%. Average right now is 5%, locking you in for 12 months. And then it can increase, decrease, but it's very minimal. You're never going to see an increase from 5 to 6% in the next year. That's just not going to happen. Okay. Um, Now the policy can lapse from you not paying the loan back or not paying enough in premium due to the fact that if you pulled out a significant loan, reducing your cash value, and the loan's accruing interest over time, over years, and you're not paying anything back, then at a certain point that can lapse the policy. So I must reiterate, pay back your loans. This is you being your own bank. That's the whole point. Do you want to pay the bank or do you want to pay yourself? I choose this one, right? Okay. So go back up to that. No. Okay, yeah, right here. So important tax information. This right here in bold. The initial 7 pay premium for the policy, as illustrated, is $3,891.63 per year. This is the maximum premium you can pay per year during the first 7 years of the policy without causing the policy to be classified as MEC, meaning Modified Endowment Contract. In result, meaning that this would no longer be a life insurance product and be considered a investment by the IRS and then be taxable, which we do not want. We want it to stay tax free, right? Everyone wants everything tax free. So keep that in mind. Any illustration that I go through with you, I will make sure you understand that. Okay. Now let's get down to the nitty gritty. So, all All right. So at age 6, when you're into the policy, we're putting in 3,000 again every year, 250 a month, right? And we're going to focus on this column over here, the non-guaranteed. Well, as I stated before, here's why are we going to focus on non-guaranteed? Well, because like I just went over, dividends have not been missed ever in 120 years. So it's safe to assume you're getting the dividend, right? Okay. So whenever you start these policies, especially it's good to know if you're putting in a lump sum, okay, because you want to take out cash like very quickly and buy whatever. Usually about 3 weeks, you're gonna have access on the low end, 75% to the high end, about 90% is usually about 85, 90. Okay. So now at first it's not gonna look so pretty. You're gonna be like, it doesn't make any sense. Well, hold on, okay. 3,000 every year is going into this policy. All right. We're at age 6 now. You got a dividend that year of $350. So you add that up with what you paid minus cost of insurance, increase in net cash value, 1,800, 1,788, and that's how much you have access to right then and there. Like, well, Pierce, that's way less than money I put in. Just hold on a minute, okay? And you have a death benefit of 113,841. All right. Now let's get down, when you're putting a lower premium without a lump sum, it can take a little bit of time to cook, okay? But these products will never lose you any money. Okay. This is not tied to the market whatsoever, and you have 0% chance of losing your money. Okay. Versus a 401k, 403b, TSP, IRA, et cetera, subject to market loss, right? Which no one wants to suffer market loss, especially when you're building a retirement account. Okay. Or having one of these where you're trying to have access to your cash value, and your cash value is doing this because the market, and it just doesn't make any sense to do, right? Be stupid. So if we look at year 6 in the policy, you put in 3,000 every year that year again, you know. We had annual dividend and 934, and subtract increase in net cash value is 3,352. So actually, let's go back. Let's go back a year. Let's go back to year 5. You put in 3,000, had an annual dividend of 785. Now you get an increase of $3,052. Now, may not sound like much, right? But correct me if I'm wrong, 3,052 is more than 3,000, right? So at this point now, at year 5, you're not even technically paying for the policy because you're gaining money, right? So now your access right here, the cash value to pull out a loan, get yourself is 11,758. So say you're at this point, you're 5 years into the policy, you haven't touched some money. Dad needs some new tires for his truck. Okay, $1,000, probably more than that, depending on what the tires you buy. But say you need $1,000. All right, you pull out a loan, get yourself. Now, the main thing I want you to understand is you've pulled out $1,000, right? So you would think that this would now be 10,758, but that's not correct. It is on the loan department side. How much you have access to would be 10,758. But when it comes to the dividends occurring and how much cash value you're getting, it's still the same. So you're still getting a dividend the following year based off of this amount. It's still going to be added to that. So you're not going to be getting a dividend based off of 10,758. You're still going to get a dividend based off 11,758. That makes sense. If it doesn't, feel free to reach out and I can try to explain it a little deeper. So let's keep going. So now we're at year 10, right? Put another 3,000. We come over here, see where we're at. We got an annual dividend of 1,346. Subtract, we now have a net increase of $4,441. I'm all over the place. So you tell me, you put in 3,000, now your account just grew $4,041. Now you have access to 30,258. Okay. And now they're what, age 15. So let's go ahead, let's go one more year. Let's say 16, right? They're getting ready to start driving, or about to get licensed at this point, depending on the kid. All right. So you're age 16, year 11, put in 3,000. We got a dividend back of 1455 and an increase of $4,216. We got an increase of $1,216 versus the 3,000 that we put in. Now we have access to 34,475. So saying that we never pulled out a loan at this point, or we have and we already paid it back, great. Now you got $34,000 to play with to go buy them a car. You pull out, 5,000, 10,000, 15, 20, 30, and pay yourself back instead of going to the bank, getting the interest rate of whatever that's going to be, getting your monthly payment, paying the bank back, getting zero returns on your money. I don't know. Which sounds better to you? All right. Now let's keep going. Let's say what? 18. All right. I'm talking about college now. 18. Oh, sure. No, you're 23. I guess so would say 18. 18 years old. You're 13 with the policy. We're at what? Increase of 1687 in the dividends. Total increase of basically 4,600. Access to 43,000. Okay. You may say, well, that appears that's not that much for college. Well, it's something, right? If you want more, then maybe you need to increase your annual premium or put in a lump sum, right? By the way, maybe they didn't go to college at 18. Maybe at 23, they finally want to go to college or go to, welding school. I don't know what they want to do, right? At this point, you don't know either. At being 6 years old, age 23, put in 3,000, got a dividend back of 2,434, an increase of 5,748. Now you have access to almost 70 grand. Starting to look pretty good, right? And we still have the death benefits. Well, we don't really want to think about that, but it's there, right? What is that? Goodness. Let me see. Uh, right. 15. No, it's more. That's 21. Yeah. Yeah. So we're looking about, where are we at? 23. You're looking at about what? About 80 something plus percent gain on your money without any liability, any risk associated with that. But there's a power of compound interest when it's uninterrupted. You never lose any money, right? Show me a 401k, an IRA, whatever you got, TSP, 403B, that's going to do that. It's just not, right? So this is life insurance and how to use it properly while you're living. Over the past, who knows how long, 100, 200 years, life insurance has been misconstrued for people to think that it's a scam, people to think that it's only for a death benefit, where there's so many more benefits to use while you're living. Right. Uh, let's keep going. Let's say at this point, a child is paying for this policy, the kid, they're 30 years old, still paying to it because why not? They can start their own at this point because, Pierce was so great, was setting them up. They came to me and wanted to start a policy with even higher premiums. I can see it, it's going to happen. So age 30, putting in 3,000 still, right? Look at that. Well, let's go back right here. Age 28. Look at that. Your dividend now is more than what you're putting in. Really, at age 27, it's damn near the same, right? Your dividend is almost as much, it's damn near the same of what you're putting into the policy. So you got an increase of 67, $6,723 right there. You got an increase of $7,000. At age 30, they have access to $117,000. And, you know, hopefully, as they're growing up and they get a little bit older and they're able to understand what this policy does, what this process is, then, excuse me, they'll be able to make smart decisions with this money and, pay off any debts maybe they have at the time. Hopefully not. But parents, while this is all still growing right here, you can use this money. Right? You have credit cards that you're paying high interest rates on. Pull that money out, pay off that 15, 20, 30% APR credit card you got, and pay back yourself for 5%. I mean, possibilities are endless here, right? We can go through many different types of situations of how you can use the money, but just kind of a cut and dry um, of how you can use it, right? And when it comes to these policies, um, really there's no limit to how many you can have. I mean, you can have the mom can have one, husband, dad can have one. You can have one on Jimmy, two on Sarah, another one on Victoria, whatever, right? But what it is going to depend on is your income and your net worth to how many you can have, right? Especially if you're funding these policies like crazy, which the max you can fund these type of products is 500,000, which really starts to kick in, especially if you're doing lump sums, which I'll get into another video like that later. But anyways, before I get off track, that's about all I got for you guys today on this child policy. So if it's something you're interested in, um, feel free to hit me up. You can go to www.cgagency.net. My email is info@cgcoverage.com. Um, Instagram, TikTok, Jack Retirement Guru. You can message me on there. And yeah, so I also will be going through some other illustrations with different amount of money put in, different situations. And I also will be doing IULs on different situations just for tax-free retirement income purposes at retirement. Okay. So hopefully this video has opened your guys' eyes a little to whatever situation you're in, whatever retirement accounts you got going on. If you guys want to sit down, we go through and I'll structure the policy based on all your guys' needs and what you're looking for. So again, Jack Retirement Guru, TikTok, Instagram, www.cgagency.net, my website, and you can book on there. You can book on my TikTok or Instagram. The Calendly link is on there, my link tree. And yeah, love you guys. Hope you have a great day. And I will be on here again shortly to run another illustration.